ओके, रिकॉर्डिंग चालू हो गया है। और जितनी देर दिख रही हो ठीक से देख लो।
Today's masterclass on financial planning for early stage startups. I am CA Ayush Yagnik, Managing Committee Member of ICAI Singapore Chapter, and I am honored to be your MC for this evening. We are glad to have presence of Team BeyondSeed, ICAI India, and ICAI Singapore Chapter, and our cohort of startups in this masterclass today. In the exhilarating world of startups, vision often raises ahead of the structure. Founders are driven by purpose, innovation, and speed. But without a solid financial foundation, even the most promising ideas risk running aground. Financial planning isn't just about spreadsheets, it's about strategic control. It is the art of balancing ambition with accountability and ensuring that every dollar spent fuels growth, not chaos. For early stage startups, three pillars define financial resilience: profitability, not just revenue, but sustainable margins that validate your business model; cost discipline, knowing where to spend, when to save, how to scale without bleeding cash; control mechanisms, from budgeting to forecasting. These are the levers that keep your startup agile and investor ready. With this, I would like to introduce the speaker. Before doing that, I would request Beyond Seed to speak a few words. Over to you, Millie.
Thank you, Ayush. Thank you so much. It's a pleasure to introduce BeyondSeed, a platform built to empower founders, investors across Asia. Our ecosystem spans across Singapore, Dubai, India, connecting investors, mentors, founders across borders. We focus on the crucial seed to pre-seed A stage where most of the startups struggle and bring not just funding but active mentoring, bridge the gap from idea to growth. We are proud to collaborate with ICAI Singapore for the Next Leap program and extend our gratitude to ICAI India and ICAI MSME ecosystem for supporting the shared vision to connect financial expertise with entrepreneurial ambition. While we will work closely with the Next Leap startups, we would love to connect with anyone who is building an interesting startup or anyone who is looking to invest or mentor such startups. So please scan the QR code whenever it's displayed and you can get in touch with us. And looking for a very, very exciting financial planning for early stage startups by Professor Neerav Nagar. Thank you so much.
Thank you, Millie. Thank you to all the partners for setting up the stage so powerfully. Now it's time to dive into the heart of today's session. Our keynote speaker is a distinguished speaker known for blending academic rigor with real world insights to shape the next generation of strategic thinkers and ethical leaders. Neerav Nagar is a fellow of IIM Calcutta. His teaching and research interest lies in the areas of financial accounting, financial statement analysis, corporate governance, and earning manipulations. His research work has been published in leading journals like the Journal of Business, Finance and Accounting, Corporate Governance and International Review, Journal of Accounting, Auditing and Finance, Journal of Business Research, Journal of Contemporary Accounting and Economics. Please join me in welcoming Professor Neerav Nagar to share financial insights on building a successful startup. Over to you, Neerav.
Thank you very much, Ayush, and thank you to ICAI Singapore Chapter and all those who have been behind this program to encourage entrepreneurs. Right, it is a pleasure to be here, and I hope you find the next 60 to 75 minutes fruitful. Uh, uh, yeah, a bit slight background. So in that sense, I've been an accounting professor over the years, teaching at IMA for more than 11 years. So startups got my attention maybe 3 or 4 years ago. And because, I tell my students also when I teach a course on analyzing startups at IIM Ahmedabad, that I was reading news about, startups making losses for several years, they burning cash for several years, right? So where is the economics here, right? Am I missing something? And I started reading a lot more about it, and that would also form the background for my today's talk, right? So I'll touch upon several points which I touch upon when I teach a course on analyzing startups here. So I'm going to share my screen now, and yeah, at any point of time, if you have questions, there are two options. You can raise your hand. Hopefully, I'll be able to track that. Otherwise, Ayush, please remind me. There's a
Sure.
Q&A tab also, so feel free to send questions there also. I'll be happy to respond, and I'll be happy to take more questions right at the end also. But I would like the session to be interactive. Right. So, let me start with a very interesting number before I tell you about the topic which I have in mind today. So this comes from one of a seminal research papers which was published in 2020, where Gompers and few others, they had done a survey of VC investors. Most of these VC investors were based in the US, but there were a lot of VC investors which were not based in the US, but in other countries. And one of the interesting stat which really hit me, and that is I always like to share, is that obviously it's a very competitive field when entrepreneurs are pitching their ideas in front of the VC investors, right? So what the first column which I've highlighted, what does it tell? That on average, in front of a VC investor, if they are considering about 101 deals on average, finally only one entrepreneur would end up getting the funding from that VC investor. Or in other words, there'll be an agreement between the VC investor and the entrepreneur, right? And as you can see very clearly how the filtering is happening. Though initially you are starting with 101, then only in 28 cases the entrepreneurs are able to meet the management. Then we see the firm would discuss this opportunity with other partners in the firm. Then there'll be due diligence for about 5 firms. Finally, term sheets would be offered to, on average, 2 entrepreneurs, and finally the deal would be signed only with one. So it is about 1 out of 101. And it is important that when you pitch your idea to the investors, it is important that the things which I talk about, right? You try to take it seriously. Some of the issues VC investors definitely look at, right? But and obviously in this time, maybe one more point which I would like to mention is that obviously in this survey there were early stage firms as well as the late stage firms, and as I hear from the briefing I got earlier, most of the people who are attending here are from early stage firms. So in that sense, as you can see, the next number to the 1.7, right? That number is even less. So it gets even tougher for the early stage firms because you do not have enough experience to show, right? With that background, let me start with today's talk, and I call it, there's a continuous tension in any startup between profits, growth, and control. And let me simplify this a bit, that when you start your firm, would you like to be profitable? Obviously, yes. At some point of time, you would like to scale, you would like to grow, and you would like to grow at a good pace. And I would say growth here means that you will be able to increase your top line, you would like to increase your profits. When I say top line, I mean sales. And obviously, you would like to get a lot of new customers, but you would also like the existing customers to come back to you, right? But when this happens, it is important that the business is sustainable. And sustainable, when I say sustainable, I do not mean to talk about the environment and sustainability here. No, I'm talking about this, that the profits which you have got, the growth which you are witnessing or you're about to witness, it continues for some period of time. It should not be just 1 or 2 year affair. And that's why the profits and growth should be accompanied with enough controls in your firm. Otherwise, that growth, that profitability would not be sustainable. That's the broad idea of my talk today. And as I go forward, I'm going to talk about a little bit about each one of these aspects, right? In this tension between profits, growth, and control. As I was told by the organizers, that there's a mix of accounting, mix of participants with accounting or non-accounting background, so or finance or non-finance background. So I've designed my talk in that sense that it is not very technical. At the same time, it is not very simple, right? But if you find anything technical, please feel free to ask questions. I'll be happy to answer that. Okay, so let me start with the profitability part, right? And having interacted with few entrepreneurs and uh, having gone through the cases of several startups, the one thing which I've really noticed is that not every entrepreneur really distinguishes between the two aspects of the performance, right? And I'm going to talk about that very soon, which is and two aspects of performance. These are reflected in two primary statements in any firm when we prepare. One is the income statement or P&L, and the another one is the cash flow statement. So I've got both in front of you, right? Now, what happens is we have an incubation unit here at IIM Ahmedabad also, and having gone through their proposals, largely what entrepreneurs are doing is they are forecasting their cash flows, right? How my cash flows are going to look few years down the line. Yes, not in all the cases I find cash flows. Somewhere, I'll just get the business details and there's no information about the cash flows. But more importantly, there's not enough information about whether their idea would be profitable or not. And obviously, profits and cash flows are different. People, the entrepreneurs who have got background in accounting and finance, obviously you can relate to what I'm saying. But I think so. There are people who are not from finance background, and that's why I got this slide for you. And in simple terms, basically, what do I mean here is that if you and I highlighted certain items here. So if you look at the first item here. So what does it mean here? That if I make a sale of $660,000, is it necessary that the cash which I receive would also be 660,000? Not necessarily, provided if I'm planning to sell my products or services on credit. And if I sell a product or service today on credit, the cash is only likely to come in the future for the credit sale. And in a particular period, my cash collections might be lower, which you can see here. The cash collections are lower by 9,000. Similarly, the same thing applies to my expenses also. Now, here in this example, the cost of goods I'm selling, or any other example, the cost of services what you are selling is 363,000, but this amount which I'm paying to my suppliers is 362,000. So my cash outflow is lower by 1,000. And in the final example of operating expenses, the payments which I make are lower by 7,000. Right now, all of these things, and yes, one more maybe. So, for example, when you are buying, are making a huge upfront investments in capex, technology, platforms, right? So you are spending a lot of cash right now, but most of the times you treat those as your investments and show them in the balance sheet, and you basically spread the cost of that asset over the life of the technology or that investment, which we call as depreciation or amortization. That comes from the matching concept, right? So basically, if I buy, for example, if I buy a machinery or a plant for $1 million and I plan to use it for 10 years, so while my cash flows are immediately going to see a hit of $1 million, but when it comes to calculating the profitability as per the income statement, I'm not going to record 1 lakh. I'm going to record, not 1 million, 1 million divided by 10, right? So in that sense, I'm trying to spread the cost, allocate the cost over a period of 10 years. And all these things are basically causing my profit number to be different from the operating cash flow number. right? And in this case, we can see the cash flows for this firm are more than the profits. Net income is the profits here. So 113,000 versus 84,000. But there's a reason why it's happening, because both these statements are trying to actually focus on different aspects of firm performance. While the operating cash flows, which is my cash flow statement, is trying to focus on my cash flow performance. How much cash I receive, how much cash I paid, whether my cash inflows are more than cash outflows or not. While in the income statement, I'm looking at cash as well as non-cash performance, that is the comprehensive performance, and I check whether my revenues are more than my expenses and whether I'm profitable or not. So obviously the question here is, in this case, I can clearly see the difference, that why this firm does not have as much profits as the operating cash flows, right? So there's a disconnect, right? And when there's a disconnect, the question is, right, should I focus on both? Answer is obviously yes, because simultaneously you are tackling two questions here. How do I make my startup profitable? And how do you reduce the cash burn, right? So going back here, so what I need to do is, as I go ahead with the idea which I have started, I have to ensure that every product or service I sell, it is profitable. I'm able to recover my costs, right? On the other hand, on the right hand side, I also need to ensure whenever I sell my product or service, it generates enough cash for me so that I need not uh, get the money. There's no need for raising money from VC investors or other investors, right? It might look, both of them might look very similar to you, but you will realize very soon why it may or may not happen, right? So I'll do that very soon. So let me first focus on the profitability pillar first. And here, I am going to talk about the unit economics, right? Now, obviously, some of these things which I'm talking about are actually discussed in a formal accounting and finance education. If you have done a formal accounting and or finance course, in the first course in accounting, second course in accounting, sometimes in the first finance course also. But the assumption here is that I know that few people have not done this. And the second thing is that many people have studied this. You have done this at some point of life, but do you really know that these concepts are very important to apply in a setting like startup, right? So hopefully, you will be able to do that going forward, right? So I'll start with a very simple example, and then I'll give you some real life examples. So here's the first example, which I'm going to put. So first of all, yeah, what is unit economics, right? So some brief description on that. At what price and volume my firm would be profitable? Do I cover my variable costs? When do I recover my fixed costs? Right. So there are yeah. If you're not aware with this terminology, then obviously. I'll give you an example to make it clear, right? So here is a simple example. My sales volume is 5,000 units, assuming I'm selling a product and not a service, but obviously this can be applied to a service also. My selling price is $30. The variable cost per unit which I sell is about $10, and there are fixed costs of up to $100,000. So the quick description here would be that for any additional unit I manufacture, right, or I buy, I have to incur a cost of $10 here. So if I sell more, these variable costs are likely to increase with every unit, right? So if I sell 10 units, the cost will be 10 multiplied by 10. If I'm selling 5,000 units, the cost will be 5,000 multiplied by 10, right? So variable cost per unit is constant, but as I manufacture and sell more, obviously the variable cost which I need to account for would be much more. As compared to that, the fixed costs are stable, they are constant, irrespective of the level of sales. So, for example, would be like if you are running your operations from a rented shop or a rented apartment, that rent is fixed, right? So that rent is not going to change if you keep even if you keep selling more. right? Whether you sell 10 units or 5,000 units, obviously, operationally, you should be able to manage your business within the same space which you hired initially. If your scale of the business is increasing a lot more, maybe even fixed costs can change, which we call as a stepwise fixed cost, right? So here is a simple example in this case. So in this case, you can clearly see that revenues would be 5,000 multiplied by the 30,000, and variable cost would be 5,000 multiplied by 10. That gives me a very important metric, right? Which all of you should be calculating for your businesses. What is my contribution if I just count the variable cost? So, and it is important because whenever I'm making a sale, it is important that I cover at least my variable costs. That's the message. And what I've seen is startups do not make profits because their contribution is negative, right? From the beginning. And I'll give you an example of an exception also very soon, and which is amazing, right? That's a real life example. But let's understand this concept first. So the message here is that if you are selling, if the cost of the product you are manufacturing or the cost of the service you are providing is $10, and if you are unable to sell that product at least for $10, then there's a problem, right? There's a problem. And what I'm suggesting is that the selling price should be more than $10 so that you are profitable right at the outset, right? Where you are able to cover your variable costs. Now, in this example, when you have contribution of 100,000, obviously fixed costs are obviously I need to pay those also. Do I cover my fixed costs? Obviously, no, I do not. And that leads to the losses of about 100,000. Okay, in this case, my contribution is 100,000. The number of units are 5,000. So my contribution per unit is $20. That is, on every unit, my revenues exceed my variable cost by $20. This is a good situation to be in, which is what I'm saying is rare. Okay. Now, why this issue is important? Because obviously, because your contribution is less than the fixed cost, you are making losses of 100,000. So in this case, what is the option available in front of you to be profitable? You have to just ensure that your contribution is more than fixed costs. If you increase your contribution and your fixed costs remain constant, you will be able to become the profitable. So I think, so the question is not about whether you are at the variable cost level, at the initial level, whether you're profitable or not. Obviously, I can see that you are making a contribution of $20 per unit. So the question is only that you have to scale your business, right? You have to basically increase your contribution by selling a lot more. Right? Now, once you are able to sell a lot more to the existing customers or the new customers, obviously you'll be profitable because your contribution would be exceeding 200,000, right? But what we see generally in startups is that the selling price is lower than variable cost. Most of the businesses are unable to cover even their variable cost, and their contribution is negative. And that is the reason they'll be in losses because even your contribution is negative, and so it's impossible that you are going to cover your fixed cost, right? So the next question is, what is that number of units I should be selling so that I break even? What is that benchmark? How much should I sell minimum so that I'll be at least no profit, no loss situation? And I think that can be calculated simply because you have got the fixed cost with you of $200,000. You basically want the contribution equal to 200,000. So 200,000 divided by the contribution per unit will give you that, right? That is a 10,000 units. And if I do this calculation again for 10,000 units, you can clearly see that this firm is in no profit, no loss situation, right? Now, obviously, more you sell, that is higher than 10,000 units, that's a good situation to be in, and you are going to have the profits because fixed costs are not going to increase until operationally, it is challenging to maintain the business. In that sense, challenging to maintain the business given the existing facilities you have, right? And hopefully fixed costs will be constant. Obviously, if the fixed costs are also increasing, if volumes have increased a lot, then you have to make sure your contribution should be even higher. right? So that's the first takeaway, should be the first takeaway for you, that make sure your contribution is positive. Selling price versus variable cost, right? Let's take some real life examples now. And I'm going to
There
take
is
you.
one question from Rajkumar
Yes,
Arya. Can we take
yes.
that up? Just
Yeah, sure. I can't see actually the
yeah, no
raised
problem.
hands.
I'll
Go ahead,
keep it.
Rajkumar, please.
Rajkumar Arya, can you speak now?
We need to promote him as a panelist.
Okay. Yes, Rajkumar Arya.
Please accept the panelist request and then come live to ask your question.
Or you decline to be promoted as a panelist.
I'm also fine if you want to send your questions on chats.
Sure, you can
so-
send your question on the message so that we can take it up at the end.
Yeah, and I'm getting the prompts there, so I can read and answer as we go ahead. So let me go ahead. And so here is the, the two real life examples which I want to talk about. This is the unit economics. I just now talked about the unit economics, right? And I was talking about the contribution per unit. And look at Zomato, very popular firm in India. This is their 2020 unit economics, right? And obviously this does not talk about the fixed corporate level fixed costs which they have got. And if you look at this is fiscal 2020, just pre-COVID, and the revenue which they were making was based on the commission which they were charging the restaurants, and the delivery charge, which was, this is per order. Note that this is a per order. So about 43.6 for the commission and 15 for the delivery charge. And the variable costs were delivery cost of about 52 rupees, then discounts of about 22, and other variable costs of about 16. And which made, because their variable costs per order were more than their revenues, their contribution was a negative. Now, obviously, we know that Zomato made losses for several years, like several other startups. And the primary reason was this unit economics. Now, unless you fix this unit economics, that is, if your contribution is not positive, remember, fixed costs are coming down, right? The fixed costs are there, right? You have to make sure contribution is sufficient to cover your fixed costs. Now, this is not this is not positive. There's no way you can make your company profitable. So this is something which needs to be fixed, and they did it, right? And if you go to the fiscal 2021 unit economics, you can clearly see what are the changes they made, right? And first of all, look at the end. Their contribution per order became positive. They went from minus 30 to 22 or 23. How did that happen? I think only one, just the one step is not going to fix this, right? And that was done by Zomato, that was done by Swiggy also. But Swiggy is still into losses because I think they have not been able to fix the unit economics, at least as per the reports I have read. What did they do? If you look at the commission, went from 43 to 62. Look at the delivery charges, went from 15 to 26. So they obviously press the pedal in the sense we really want to increase our revenues. And what are the other options? Obviously, reduce your costs. Look at delivery cost, went from 52 to 45. Discounts, 22 to 7, and other variable costs from 15 to 14. But largely the changes were in the first four pillars, and that made the contribution per order, positive. And if you know, for the last 2 years, the Zomato, which we now is obviously eternal, is profitable. Note that Eternal obviously has got different businesses. Zomato's food delivery, they have Blinkit in terms of the grocery delivery, but they have Hyperpure also. Hyperpure is the B2B grocery supply, and the fourth one I think is District, where they sell the tickets for events and movies. So I think the challenge for them is, so challenge for a business like this is that even if you get the unit economics right for an established business like food delivery, for them it will still be some challenge going down the road to get the unit economics fixed for Blinkit, District, and Hyperpure. I think Hyperpure, they are really making losses there. So now here's another example, and I'll say this is the way business should be done. And many times people say, okay, it is tough for me to make my unit economics positive because it's a competitive business. I need to get customers. But think about this business, Zerodha. Zerodha is a very, popular firm in India. And what they were doing, they were providing basically the stockbroking services, right? While Zomato and Swiggy, when they came, when Uber and Ola, they came, it was like, shaking up the industry in the sense people had not heard whether it can be done, right? That you can order the food and get it quickly. You can request for a car and get it quickly. But people were dealing with the brokers earlier, and online broking was also happening. The online stock trading was also happening. But the way they made it so simple with the help of the technology is remarkable, right? And look at, they started, I think, in late 2010. Look, from first year FY11, they actually broke even, right? So what break even means here, that they were actually in no profit, no loss situation right in first year. How many firms? I have at least not, maybe there's a, I don't know the year in which they became profitable, but I'm forgetting the name now. They are into several online games like Rummy and other. Obviously, recently there was a ban on that, so they faced setback. But there's an online gaming firm. I'm missing the name right now. I think they also were profitable quite early on. So here, if you look at the profit trend, right, and the customer acquisition, all along from the beginning, the unit economics were positive. And the biggest surprise is, we always talk so much about, oh, mine is a startup. I'm going to initially be into losses. I'm going to burn cash. That is, my operating cash flows would be negative. I definitely need money from VC investors or angel investors to save me. But do you know, Zerodha till date has not taken a single rupee or dollar from any VC investor. They bootstrapped themselves. Both brothers, they always put their own money, right? They have not taken a single rupee from the VC investors, right? And they have been profitable right from the beginning. I can see a Q&A. No, okay. Yes. So yeah, I'm reading this question. I think Manik, hopefully it is for me. So no, I think I am very clear, and I had told the organizers earlier also, I am not going to talk about how to raise funds. I think there's another talk which has been planned for that.
Yeah, so Manik Chauhan, I see your question. Just to give you a background, we'll be having a separate session on fundraising subsequently in this masterclass. This is only for the financial planning. I hope that answers your question.
Okay, so I see another question. Can you explain contribution versus EBITDA? I can give you a basic idea about this. Then obviously, when I talk about EBITDA, it is profit before interest, depreciation, tax, and amortization. So I would say that, because in the EBITDA number, you are not. I'm sorry. I think there's been some issue here. Give me a moment. Yes. Okay. So I hope you are able to see the main screen. I hope you can see the full screen, Ayush.
Yes, we can see that.
Okay,
Yes,
great.
we can see.
So the EBITDA number, how it will be different from the contribution number in the sense that EBITDA number obviously is after certain fixed costs, right, at the operational level. The only fixed cost which is at the operational level, it is excluding is your depreciation and amortization, right? Interest is obviously a financial fixed cost. So contribution less other operational fixed costs would take you closer to the EBITDA number, right? So in my analysis, what I'm doing is I'm differentiating between the nature of the cost based on their behavior, whether it is variable or fixed, right? And I'm not taking an approach which is more popular in financial reporting, where the EBITDA term is used because they say that, okay, I want to separate out the exceptional items at the bottom, right? I do not want to count that when I analyze the performance. I want to focus on the recurring performance, and I want to exclude depreciation because depreciation is a non-cash item. So I'm looking at a profit number which is closer to the cash flow number, right? These slides would be available to you later on, so feel free to look at. So now I'm talking about the issue of the cash burn, and this is about some of the stats which are available in India. So remember, now I'm moved from profitability to cash flows, okay? Because profits can be different from cash. So this is about whether you are having your operating cash flows positive or not. Because if your operating cash flows are negative, right? Maybe before this slide, maybe I'll show you one of the cash flow statements of Cone Corporation. This is a Norwegian firm. And those who are new to finance, they should know that in a cash flow statement, obviously, there are three categories, right? So when I put my cash inflows and outflows, when I show them in a cash flow statement, all my receipts and payments, I divide them into three categories, right? Which you can see here. Now, obviously, what is financing? How am I funding my business, right? Where I'm raising the money, how much do I repay them? Investing is about long-term investments in machinery, buildings, technology, R&D. Capex, another simple term I can use. But the first one, the cash flow from operations, is the main category where you really want your numbers to be positive, which is happening with this firm because this is not a startup, right? This is just an example I've taken. This is not a startup. They are cash flows positive, and as you can see, in the recent year 2023, they make operating cash flows are about 1 billion euros, right? Or 1128 million euros. Okay. Now what happens? So this is basically your operational cash flow performance, the first category which I've highlighted. What happens when you burn? So cash burn is nothing when you have a negative operating cash flows. So when you do not have positive operating cash flows, that is negative. That means your operating cash outflows are more than operating cash inflows. Obviously, your investment in capex technology in the investing category, they can also be added to the cash burn. There's an alternative definition of cash burn, that my total cash burn would be how much money do I lose from operations as well as my investments in technology R&D. Right now, in both the cases, if I'm negative, here it's positive, second place it is negative, then obviously who is going to support the business? Who's going to finance the business? And that is where the VC investors come in. And whenever they put any money, that is classified under financing section, right? So they will put a lot of money here so that they can bridge the gap which is here. If you're burning cash in both the places, operating as well as investing, right? Then VC investors are going to bridge that gap. They are going to give you funding for the cash which you are burning. So now that's what, if I go back to now the last slide about cash burn, right? And look at some extraordinary stats, I would say, right? Because we are talking about startups that burn 1 crore or more every day. And these are some, I think all of them are very popular firms, right? So the question, and you look at the heavy spenders on the right-hand side, they are spending 2x of what they earn. So obviously they can't be net cash flow positive. Unlikely they are actually profitable also, right? And all of these firms are good. So the interesting thing is, if I go forward now, right? And obviously I've talked about this, and then maybe I'll ask the questions which are in my mind. Uh, um, how much cash you generate from your operations? Have you really tracked that, right? How much you invest for the long term in the investing section? Do you really need that funding? So how long you continue with that funding, right? And over a period of time, all entrepreneurs would have some idea about how soon they would like to, would be able to generate cash from their operations, right? So what are the questions, right? So maybe I'll raise some questions and then I'll come back to this. Okay, maybe I'll wait for that. This is another way, a cash flow statement can be prepared. Again, things will be technical, right? For example, the accountants would obviously know what I'm showing right now, because this is again a cash flow statement operating section, but it is prepared using a different method. Now, when having taught several participants from non-accounting background over the years, the most technical thing they find is this, right? And they say that, yes, it is very technical. But the most useful thing they learn in accounting is also this. That is the feedback I get. And because when you prepare a cash flow statement using indirect method in this way, you basically know that why there's a disconnect between profits and cash flows. So for example, if I look here, the firm makes, this is about obviously Netflix, again, no longer a startup for sure, several years now. But if you can see, they are making profits of 5 billion in 2021. Okay. And their cash generation was 392 million. So cash generation was way lower than the profitability, right? So why was that they were not able to generate enough cash, even despite the profitability of 5 billion here? And so this clearly tells us, so whatever numbers you see in parentheses here, right? So let me bring the focus back. So I'm comparing the profits with cash flows. Now, whatever numbers you see in parentheses here are obviously minus in negative. Now, what are the reasons why profit numbers differ from cash flows, right? Let's look at that. But note that in 2023, while the profits did not see much change, they're still around 5.1 to 5.4 billion. Look at the cash they generated from operations. It increased a lot, 392 million to now about, we are talking about 7 billion, right? So how come the profitability did not change much, but at the same time, they were able to increase the cash flows a lot, right? And the answers are in between. Answers are in between, which I have highlighted in purple, right? So because I can clearly see what are the items which cause the disconnect between my profit and cash flows. And all the items which are negative here are the reasons, right? So for example, if you look at the content assets, so we are talking about basically the movies and the shows, right, which they have hosted on their platform, right? So when they buy those, right, there's obviously a cost involved, right? You have to pay cash, right? And you can clearly see that initially the amount blocked because of that amount of purchases was to the tune of about 17 billion, which they reduced to about 12 billion. Hopefully, maybe they were procuring more than what was needed there in terms of because the viewership prediction, what kind of shows they are watching, what kind of movies they are watching, they must have done some calibration on that. But at the bottom also you can see some changes. For example, there are other current assets, including receivables, where also they reduced the blockage of cash. It was, it reduced by almost 50%. So these are the examples, you know that if my firm is, here's a scenario where my firm is profitable, but my cash flows are, less, right? Then what actions do I need to take? Right. So there's a signal that wherever if you are giving a lot of credit to your customers initially, maybe try to reduce that. If you have a lot of amounts blocked in inventory, maybe you try to reduce that. Try to, even if you have to give credit, even if you have to hold inventory, assuming we are talking about a product business, can you take credit from your suppliers? Can you find suppliers who can actually fund that blockage? Obviously, another term which we use for this is the working capital management, right? Right. And so again, some examples I'm going to take here. If hopefully you'll be able, sorry, not this one. The real life examples, 3 forms which I have used here. First, I'm talking about Paytm, right? And again, these are real world stats. The firm was founded in 2010. And look at initially for how many years they had negative operating cash flows. They burned cash for a long period of time. And only by FY23, they became operating cash flow positive, right? And obviously in between, you can see they had a lot of investments, most probably largely in the technology, the platform. right? So it took them a lot of time. So I would say roughly 13 years, 12, 13 years to become cash flow positive operationally. Another firm, PhonePe, right? Look, when they started, founded in 2015, still the latest data I have, still they are not operationally cash flow positive, and they are investing a lot for growth also. This is the cash burn. Cumulatively, they're still having a lot of cash burn. And every time they're burning cash, VC investors are coming forward to save them, right? Flipkart, another popular firm, started in 2007. When did they become cash flow positive? Only after 12 years, right? And they were burning cash all throughout. And obviously, it has been profitable for quite some time. And Walmart also showed some interest. Okay. Let me go back to my original slide. I'm going to come to this issue later on. Yes. So I've already shown these examples. How do you reduce cash burn? So obviously some of these things should be intuitive, that how can I reduce the cash burn? But the straightforward is obviously, as I say, it's easier to say than do it, that increase the operating cash flows. But how do you increase the cash flows, right? Operating cash flows, right? Look at the pricing of your product or service, right? Is it appropriately priced? Because if you are, say, it's easy to say that, yes, mine is a new business, I need to get customers, I need to get traction, as they say, and I'm going to give discounts. I'm going to give discounts to get the customers with me. But as soon as you give a lot of discount, the threat is your unit economics, right? Would you be able to cover your variable costs or not? So discounts are not going to help. And I think, and I'm very clear about this, that customers are not there to be, for the startups, like customers are not there with the initial feeling that, hey, I'll be loyal to you, right? If there's a Zomato in front of me, if there's Swiggy in front of me, or it is Uber, Ola, right? Or now Rapido, I'm looking at the lowest fare. I'm looking at the lowest cost of food. And whichever startup is going to give me at a lowest price, I'm just going to go ahead with it, right? And I'm going to avail the product or service from there. And note that there's not much of differentiation in the service, right? So largely I'll be able to get the food within 30 minutes, right? I'll be able to get the car within 5 to 10 minutes, right? Maybe location specific, you might see some differences in the service parameters on average. In general, I'm talking about that. So should you be differentiating based on the discounts, how much of discounts you give to the customers, right? It should be more about differentiating your product or service vis-a-vis others, right? So that's the first 2 points. Can you reduce your operational costs? Look at your business model, right? Can tech help there? Or there are some other aspects which can help. For example, case of Zerodha, Kamath brothers are very clear. From the beginning, they made the tech so easy and so useful for everybody that they kept getting customers. So they're clearly saying the tech is the important issue. Interestingly, they also say that we did not, we never wanted to spend enough on marketing and advertising. We deliberately kept all our costs on advertising, marketing, promotion very less, because our tech was good. It was simple to sign up, register. Anybody could start trading very soon, and the word of mouth just went ahead, and they actually saw the exponential growth. And contrast that with the new age firms which are coming. If you've heard about Upstocks and Grow, and all major cricket tournaments I saw, they were always there when it comes to advertising. So they spent a lot on advertising and marketing, right? But why? Even if I see a good advertisement there, right? Obviously, my marketing colleagues might have a different response here. But I'm on Zerodha. I love their technology. I love their service. They're not charging me enough for that, right? Why should I make a switch and go to Upstocks or Grow, right? And the unit economics is a big challenge there rather than Zerodha. Or finally, the last point here is obviously, can you sell more to cover the fixed costs? I've already talked about that. Right. I hope there's no question at this moment, so I'll just continue. So how much should you continue spending on R&D, technology development, and platforms, right? This is another. Now I'm actually talking about the investing section of the cash flow statement, right? Again, if your operating cash flows are not positive because of the reasons which I mentioned in the first point, that will create a pressure on you that should I now, there's a limit I decide that, okay, I do not want to spend on tech more than this, right? If your operating cash flows are positive, you can continue doing that, right? So that's another advantage if you, from the beginning, if you take care of the unit economics, right? You can keep upgrading, improving your technology using the funds which have been generated from operations. And you are less relying on the VC investors here. Right? So that is the question. I showed you some stats on different real life firms, and I always ask, how long should you burn cash? That is negative operating and investing cash flows. We are talking the stats which I've shown you, largely it has been 12 to 14, 15 years, right? Why are VC investors so patient, right? For me, it is not good economics, right? And I'm very clear in my opinion here, and that creates some good discussion in the classes which I take, right? So obviously, one of the surveys which I was reading that when which is the most important thing VC investors give value to when they are actually funding a startup, and there were two interesting things: horse versus jockey, right? So I'm talking about the business model, which is the horse, and jockey is the founders, right? They really give these two things a lot more importance when they invest, right? But do they forget the unit economics, right? Or even if they remember, right? Can they make the entrepreneurs or founders accountable that, maybe 4 or 5 years down the line, I want to see positive unit economics, right? It should not be 15 years. And for me, I'm very clear, right? I do not want this to be 15 years, right? Yes, there'll be competition in the market, but from the beginning, if I can't make my selling price more than my variable cost, then there's some problem. Some problem, okay? And that is what I encourage people to worry about. Right. So again, it's an interesting question, right? Are the VC investors only looking about their return? Okay, that I don't care about the unit economics. So this is a burning question, right? So it's not that I definitely feel this, but the burning question is VC investors are exiting at the X price of stock, and when the firm goes public actually going public is considered as kind of a success for a startup, right? For I don't think so that should be the parameter, right? Because I've clearly told you I want operating cash flows and profits to be positive. So when you're saying, okay, going public is the yardstick of success, a VC investor bought the stake at per share price of X. VC investor is able to exit at per share price of Y, where Y is more than X. There's a target return. VC investor got that. Is the problem solved? I don't think so, right? And we have seen that based on the volatility of the funding season, or things like, when COVID came in, suddenly there's a downturn and, the startups start firing employees. Do you really care about employees, or is the game only about the VC's return or the founder's return? Do you really care about employees? Do you really care about society? That what if your firm closes down? What if you fire employees? Right? And anytime you are driving, you are using the service of Uber or Ola. If you are based out of India, right? I don't know about Singapore, and strike a conversation with any of the Uber or Ola, more so of Uber, right? Drivers, and ask them, how long have you been associated with them? And if anybody who has worked with these firms for a long period of time, there'll be some interesting stories. And you will know how tough has been for them also, right? Was the firm fair to them over the years or not? But that was their perspective, right? So I have some understanding of what these companies think about what they're doing for employees. But at least the stories which I heard from the drivers has been really heartbreaking in some cases, right? Right. So, but if you focus on positive unit economics or and the positive operating cash flows, everybody has to gain here, right? I don't think so anybody can lose here, right? Provided it is not at the cost of the controls and the ethics, which I'm going to talk about very soon, right? So finally, my last point on cash flows is this, that all startups are going to see this kind of curve, right? And what this basically says is it actually plots the cumulative cash flow needs. What is the total amount of cash you need for running your startup? That is what you see here on the y-axis. On the x-axis, you can see the time. And what you see here is that the cumulative cash flow, that how much of cash you are raising or burning, initially it is negative. As you go down, if you can see, the curve slopes downwards at the bottom, because your operating cash flow is negative, you're investing a lot in R&D capex, so this is going down. You can clearly see this is going down, right? And as you can see, the slope they have highlighted, the slope is basically your burn rate. So that means in a particular month, how much cash do you burn, right? Every month or every year or every quarter, how much cash do you burn? That is the rate at which you are burning cash every month or every year, right? And what you see here is the date first your cash flow positive. That means in a particular year, your cash inflows are more than cash outflows. The cash I received is more than what I spent. That is the first year in which your cash flow positive. So that takes some time. And that's the point, because your operations are now giving you cash, you no longer need outside money, because you are generating cash on your own. And that is why what is known as the maximum financing needs. The maximum financing needs is about the total funding you will need from outsiders. Okay. Post that, you are generating enough cash on your own, but obviously annually you are obviously generating positive operating cash flows, but it will be a time before you actually cash break even, which is the last point which you see here, because you'll have to obviously repay whatever you have raised, right? And that will be covered only after X number of years, which happens much later. And then later on comes a time where you are just, generic, your cumulative cash flow is positive. That is, you have a positive cash and bank balance, right? A point or two about the focus, right? So another, let me start with this. So the question here is, do you, when you go to the VC investors, should you prepare a forecast and pitch in terms of when you are discussing the product, service, and the idea and the management details? Do you also show the financial projections, right? And if you decide, yes, I need to show financial projections, then how long you should be doing it for? So again, let me give you a hint. So let's ask the VCs first, right? What they do, right? So I'm not talking about what the founders do or entrepreneurs do. So this again comes from the same paper which I started with today. And what do the VC investors say? So if you look at it initially, the first column here, so this is the percentage. 40% of the respondents in the survey said that yes, we do have we ourselves build the forecast for 3 to 4 years for that firm, right? Interesting. Most of them, followed by 5 to 6 years. But yes, there are a few people who actually do not prepare the forecast. On average, it is about 3 years. So when they make the forecast, on average, it is for 3 years. And whenever they build the forecast, right, how many firms on average are able to meet or beat that? Only 28%. 72% of the firms actually fail, right? So I think I see a question. So there's a first question from Shravan, difference between forecast and budgeting. I would say there's not much of difference, because when you are forecasting revenues or costs, right? What is the idea of the forecast? That one is obviously you are giving some idea to the investors and yourself that, okay, this is how much my revenues or costs would be going forward. But what is the use of that forecast if you don't compare with the actuals, right? That then finally the actuals come and you are going to come with that forecast, and you will know that, what is the variance. And that's the next point I'm highlighting there, right? That whether my actuals were close to the forecast or very quite distant from the forecast, and why this variance is coming, right? whether I spent more than what I planned, whether my revenues were less than what I thought. What is the reason? What was the sales price was the reason? Was volume the reason? Right? Or why did I lose control over my costs? Right? So I would treat them as similar. Jitendra, normally VC and PE funds are able to exit and get their desired returns. However, retail investors end up paying higher prices, right? Is there any regulatory framework to protect? I'm not a professor in this area on regulations, but see, when you invest in a IPO of a startup, like recently, I think we had Urban Company in India, right? They have given you, so in their of public offer, right, there's a price band. The price band is telling you that maybe the investors, initial investors want to exit and they are willing to sell their shares at this price band, right? This information is there with you. And with that, there are so many disclosures, right? Do you think, now obviously there are two things here. There are so many disclosures there. In there, you will find whether the company is profitable or not, whether it is generating positive operating cash flows or not. You have some idea about the unit economics there, right? And then obviously there's a price band, and price band obviously depends upon the valuation of the firm. And on average, a retail investor does not have the expertise or the sophistication to do a valuation exercise, right? So she is going to rely on some experts, like you have broking houses, the research firms, which are going to give some suggestion on what is the ideal valuation of that firm, based on which you are taking a call, right? Now, based on that, you take a call that, okay, I want to buy the shares of Urban Company. Time will tell whether once the stock lists, the price increases or goes down. Why you should blame somebody else? It was your investment decision, right? And if the price does not increase, right, obviously, it was a bad investment decision in terms of making money, right? So I always tell my students that the investing is about two things. One is you identify a good firm, right? And the another thing is you buy the stock at a good time, right? If the stock is already overvalued and then you are buying a good stock, then obviously it's too late. You cannot make money. So investing is about two things, right? And I guess today my focus is more on good firm, right? Which is a good firm, right? Where operating cash flows are positive. If not sooner than later, but it's not 15, 16 years. This is at least my view. And yes, the regulations would help you where you think that any of the disclosure you saw in that the DRHP which they filed, right? If any of them was wrong, right, then obviously there's a legal liability there, right? And then you can obviously take the support of that. When I invested, I actually relied on a wrong information which was given to me. So as the shareholders will come together and maybe there will be a lawsuit and you will be helped. I see another question from Shivam, sir. When you're forecasting, is it to consider future funds coming in, or did VC evaluate on current sales? So what I'm showing you right now is do VCs do forecasting of financials for the firms they want to fund? This is about that. This is not about VC's own financial performance. Okay, so let me continue and right. So yeah, that's very clear from that picture that not all VCs build formal revenue and business model, but a lot of VCs do that, and it is very clear. So if they take it seriously, obviously you should be taking it seriously, no doubt. And they really want to see whether how are you monetizing your product or service, right? How are you going to generate revenues using the product or service you are offering? And hopefully they are worried about the unit economics also, right? So when you make this forecast, think about the assumptions you make, right? When I say assumptions, so what I'm saying is that you will obviously assume that I'll be able to sell my product or service at some price, maybe 3 months down the line, 9 months down the line, 1 year down the line, right? Is it a really practical number to take, right? In terms of the cost also, right? Try to get to it can't be the correct number, obviously, because nobody knows what's going to happen in the future, right? But at least based on your logic, gut feeling, you should be convinced. Because because let me show the third point first. Because I asked my students, right, if you go to the VC investor, what kind of projections you are going to show? Whether it will be, are you going to show the pessimistic or the optimistic one? Because I can always prepare forecasts in three, maybe different ways, but at least two would be, one will be highly pessimistic, where I'm very conservative. Conservative means I'm going to underestimate my sales and overestimate my costs. And optimistic would be overestimate my sales or underestimate my costs, right? Which one will you show your investors, right? And most of my students say, I'll go with optimistic. And then I say, if you show the optimistic projections 2-3 years down the line, the probability of you not meeting the optimistic projections is very high. Remember, not meeting. And that time those investors would be disappointed and you lose they lose the trust, right? They are not going to trust you. But if you go with the pessimistic, obviously there's some risk. Maybe you are not demonstrating your true potential, right? Maybe you are underselling your idea. There's a lot of merit in your idea, but with the pessimistic projections, you're losing that edge. And if there's a capital rationing where VC investors are looking at two firms, almost similar nature, VC investors have limited funding. They have to choose one investor. Maybe the one with slightly optimistic projections might get the funding, right? But as a founder, I think you should not be worried about this. I would say maybe if you don't want to go with pessimistic, right, go with something realistic, maybe somewhere in between, right? And when you are presenting your idea in front of the investor, right, give the rationale as to why my sale projection looks like this, right? Why my cost projections look like this. There has to be logic everywhere. And I'm going to give some idea about where will you bring the logic from, and also do some sensitivity analysis on your assumptions, right? So even if you're going with the forecast, do check that what happens, so I thought I'll be able to sell my product at $100, right? What if I have to reduce the price to $80? Do I still have profits? Do I still cover my variable costs, right? What if my volume, if I'm unable to sell 5,000 units, right? Will I still be able to make profits, right? Same thing applies to cash flow. So do that sensitivity analysis, right? And here is something, maybe I'm going to come to that. It's linked now. Now I'm talking about the growth also. So what happens? So so the first idea is obviously have to be profitable, but and I want to grow also. I want to get more and more customers. I want to get repeat business from the existing customers. So the next set of questions are, should I set any boundaries for my employees as I try to grow? Right? What kind of internal control should I keep in place? Right? I do not want to grow without controls, because that can harm the firm as well as few people. Right? What kind of financial measures should I keep in place? Right? How would employee compensation be structured? And a very, very interesting and crucial question, that initially, should you have a board in place, even though it is not a statutory requirement? Okay, so let me continue. I don't see any question right now.
There is one hand raise from Veena Arora.
Please go ahead.
Hi, Veena. I saw your raise hand. You have any question?
I see a question from her. Will this presentation be shared? Yes, obviously I'm going to share with them and you will get it.
Okay, fine. So then we can continue.
Continue. Okay. So these are some of the next set of questions, and related one is obviously the budget. Somebody was talking to me about that, right? A related point is that, and remember, so why I'm talking about budgets now? Because I said that you want to grow, right? When you want to grow, you want to sell a lot, then obviously you'll be spending a lot more also, right? But can spending happen uncontrollably? Do you need some controls there, right? That, okay, yes, we need a lot of spending in building my platforms, right? I'm going to spend a lot on technology, but can they be without any fencing, without any, budgets, right? And that is what I'm saying. And I gave you the example earlier about Zerodha's decision not to spend much on advertising marketing, right? So yes, you tell your employees, okay, I want my top line to grow. Go and get customers, right? Obviously nowadays all these promotions are happening digitally. But how much should I spend on these promotions, right? Do you want to put a bar, right? Because if you say I want customers at any cost, then you lose control here, right? There's a lot of spending happening on marketing, right? But I do not want to lose that control, right? And do something like this, right? So where when you're putting the budget and then you can compare with the actuals to find out that which of the costs says I'm spending a lot more. And when it comes to sales and the costs also, you can also look at whether it's a volume effect or a price effect, right? This is something I really tell my class to do every time they're doing this analysis. And hopefully, yes, you'll be able to see the screen now. This is known popularly as fishbone analysis, and I think very few startups actually do this. So this is coming from one of the cases I teach here at IIM A, where I challenge students to actually so this is for a particular firm for there's a forecast for one particular month, for the month of May, and you can see the contribution per month for them is 20,000, right? And it was basically a kind of a car renting business. Uh, and you can see that the contribution per member is $90. So their contribution is affected by the contribution per member, which is, so it's a unit economics is positive, and also the number of members. Multiplying both, you will get that. And contribution minus your overheads would give you the profits, as I told you earlier. So in this case, everything makes sense. But you really need to, okay, so, and this is a forecast, remember. So this is a forecast, and my contribution is driven by revenue and cost. My revenues are driven by the fixed membership fee, for what duration they use the cars, how long they run the car, for what distance, for how many hours do they use the car, and I have the details at very granular level. So how much I charge per mile actually decides my revenue and my contribution. How much I charge per hour, that's going to determine my contribution. Similarly here about the costs, right? What is the utilization rate? How long they use the car? That is going to determine my costs, right? And there are some fixed costs also, right? Everything. Do you have everything recorded very clear in your mind about what are the key drivers when it comes to, which affects my contribution here? This is known as fishbone analysis because it looks like the skeleton structure of a fish. And once you have done the forecast, when the final operations start, you can compare the actuals at all the levels, and you'll be able to know that where I'm struggling. So I've given you an indication. Wherever you see a downward arrow, that means that's a problem area for me, right? So from the right-hand side, you have to start, right? Or here, you are going to start and see, that my dollar per mile is much lesser. My dollar per hour is much lesser, right? The utilization rate has also gone down. People are using the car for much less duration than I thought. I thought 40% utilization rate, and some of the costs are also increasing, right? So at this level, you should do the analysis, because if things are not good here, everything is downhill in terms of revenues and uphill in terms of cost. That is obviously going to affect the contribution. And now you see what's happening. They thought the contribution per month would be about 20,000, and what it turns out is about $5,000. And contribution per member has gone down to $29. Right, I think there's no question, so let me go ahead. So this is the fishbone analysis, which I would encourage everybody to do. Let me continue with some more inputs. I hope I have time, Ayush.
Yes.
Okay, so just let me know, and then I can wrap up whenever you will indicate. So now some what are the other controls and other controls you can place? How in a better way you can govern the behavior of your employees as you start your new venture? So this is about the performance, right? So how do I measure the performance of my employees, right? Should I keep it dependent on the outcome, in the sense how many customers you get, right? How many, digital impressions you generate on the web, right? Or should I focus on the process, right? The process here is, okay, my job is to provide a good quality product or service, right? What kind of metric should I use? Should I focus on financial, or should I focus on non-financial. So financial example would be your profit, cash flow numbers, or the ratios, or the new product launches, right? Or the new products in terms of service, right? Should I have my metrics as absolute or relative? So absolute will be sales and profits. I'm looking at the absolute numbers, and a ratio would be a relative because I'm dividing the sales and profits by my total assets or sales to see whether my profitability is improving. That is, my profits are increasing, but keeping size constant, right? I control for the size because obviously absolute numbers will increase if my firm grows. So I want to look at both the numbers, right? Or you can have a benchmark, me versus them. So if you have peers in the same industry, you can say, okay, this is my ROA, this is how my performance looks like, whether I'm doing better than others or not. So these are the calls you have to take. And my suggestion here would be always have a balance, right? If you focus too much on financial numbers, then you will lose the control, okay? Because I think it's tough in the sense that, okay, if you have to increase the sale, but given everything, I can sell a lot, right? Without worrying about the fact that did I give full information to my customer about my product or service. So mis-selling, basically, mis-selling is a very popular term. And when you have non-financial metrics like think about the customer satisfaction ratings, right, or the customer feedback, or if it's a product business, right, the defects, for example, right, the defects should be minimized in case of a product, right? So those will help, right? And the related issue is that how do you then? So this is about analyzing the performance for the business, for the department. What about the executives? How do you compensate them, right? So I again teach a course on corporate governance here, and this is all coming from there. How should I compensate them? Should I give them cash or should I give them non-cash compensation? For example, so there's cash versus non-cash. I'm coming to non-cash very soon. This is all about stocks, actually. I don't give cash compensation, but I give them stocks in lieu of the cash compensation. And when I set up the compensation, should I monitor, assess their performance over the short period or a long period, right? And that's the debate. So now, when it comes to, you see, in this, there are several ways in which employees are compensated. And if you look at this, the last four, the fourth, fifth, and sixth are largely about the stock-based compensation, right? I can give stocks, I can give stock options, I can give performance share units. That is, I'll give you an example how PSUs would be different, right? Now, if you look at all of these, basically, for example, if I look at salary, obviously it is not related to performance. But when I look at the bonus versus LTIP, second and third year, well, bonus is linked with the short-term performance of the firm, maybe annual performance. LTIPs are generally linked with the long-term performance, right? Maybe 3-year, 4-year cycle. Last 3-4 years, how well you have done based on your targets, right? And similarly here, stock PSUs are likely to have more long-term orientation, long-term performance, right? So I'll give you some real-life examples in a minute. So when you set up the compensation for your employees in a startup, again, you have to keep these things in mind, right? Because you don't want to make it too complicated. You want to incentivize them that they do the best for you, shareholders and all the stakeholders. They should be able to take some amount of risk, right? They should not play a safe game that the business does not grow. Should be forward-looking, should bring loyalty amongst your employees so that they keep working for you. And this is where it comes. You know that most of the startups are actually rely heavily on stock-based compensation, right? The interesting question is it because they are short of cash? That's why they're giving stock-based compensation? Maybe the answer is yes. But I'm saying you give stock-based compensation when you really want people to be with you, right? Because when you give people ownership, you are creating a sense of belonging, right? And that loyalty would come from there, right? You'll be able to incentivize them also because in stocks, if the stock price increases, they gain a lot more. I do understand, and I think it is prettily applied in the sense that initially startups are not listed, right, until they go for the public offering. So what they will have to wait until the firm goes public, and then only they'll be able to see the correct market value of the compensation or the stocks which they have got. But you have to think, and also I'm going to tell you some interesting examples versus some established firms like General Electric is obviously age-old firm, very old firm, very mature firm, and the way compensation would be set in a established firm would be quite different from a startup, and that is what I'm showing you here. So if you look at General Electric here, they have got all the components I talked about. They have got salary, bonus, they have PSUs, they have options, they have restricted stock units. So basically, restricted stock units, what happens is there's a vesting period. So even though I'm giving stocks as compensation, right, they will vest in the employees only after a certain period, right? Now, so how complicated? Now, compensation can be as complicated as you want to make, but at the same time, even if you make it complicated, it should be useful. So what GE does here? So GE does is that when it evaluates its top management, it actually first of all, several things to look forward to here is, see, they're focusing on revenue growth, they're looking at profits, they're looking at margins, they're looking at cash flows, they're looking at everything. Right? And different businesses, they are using different, right? For example, renewable energy, they don't want to focus on revenue growth and margins, right? They're looking at profits and cash flows. They have their own logic why they're doing this. They have not discussed this in the annual report, but they are not looking at just absolute performance. They are looking at relative performance vis-a-vis their peers. You do well, but how will you do as compared to your peers? And those peer firms every year are disclosed in GE's annual report. So my performance is assessed on the basis of these 4 metrics, but it has to be better than the peers, right? And there's some more examples here, right? How much bonus I'm going to get. They're also looking at, for example, the stockholders return, the stock returns also. So basically, again, it's a mix of variables which are coming from your financial statements like earnings per share and cash flow from cash flow statement. But at the same time, they have a market number also, the stockholder return, and that's relative. That means the improvement in your share price should be more than maybe the S&P 500 return or some of the peers stock market return. So relative performance has to be good. But compare that now with Tesla. This was the original in 2012 when they came out with a compensation plan, right? And it was really popular in the sense, at least I had not seen anybody doing something like this. And remember what I showed you for GE, for established firm, that clearly defined profit, cash flow, returns, etc. What did Tesla do? Very different for Elon Musk, right? So he was about to get stocks for sure, but what the compensation committee of the board said that you are going to get whatever is the stock-based compensation we have decided for you, you are going to get in different installments, and every installment you will get based on these achievements, right? So they're finally, whether you'll be able to launch the alpha prototype of Model X or the beta prototype and the subsequent models, Model 3, alpha, beta, finally the production completion. But they had some other interesting, they had gross margin for sure, right? And the vehicle production. Again, very interesting plan. You have got so many metrics there, but this is what you may want to do at least the first 6. I would say at least except the last 3, right? Really make sense for a startup, right? So you're basically saying, okay, can we come out with a successful product or a service here? And this is linked. Remember, this is linked to my control part, right? So in this way, you can control the behavior of the employees, that your company is profitable, continues to grow, right? But this is going to mold their behavior. And so this was 12, right? Let's go to 2018. 2018, after so many years, when Tesla had actually set up itself, it has got stable. Look at how did they change the performance award within 6 years. Whatever you see here, none of this is present in the 2018 plan. It is just revenue and EBITDA. So this indicates that when you have these compensation plans for your employees have to be dynamic, right? As you change. Initially, as a startup, you might to give weightage to something else when you give them compensation, when you want to assess the performance of the employees. But as your firm settles down, might have to think what benchmarks to use, what metrics to use to compensate, how to evaluate the performance, the variable component of your compensation. And a final example on executive compensation, and again, I say this is very different. Again, Netflix, right? They don't want to go, they're very clear. We don't want to do this complicated business. We'll give only two: salary and stock options. That's all. No bonus, no LTIP, no restricted stock, no PSUs, right? And the great thing is personal choice. I tell you, this is your compensation, right? You decide whether you want cash or whether you want stock and how much, right? And that's very novel, right? No complications, very simple, and employees decide whether they want stock or cash. Some last few points on governance overall, right? Remember, I'm talking about growing with controls, right? So first I talked about budgets, then I talked about performance assessment, then I talked about the executive compensation. Here it's about the governance, right? And what are the different aspects of governance? Very interesting survey came in 2018 from Stanford, and it shows that basically when the firm comes out with an IPO, right? How much time does it take? So, for example, on average, it takes 9 years to come out with an IPO. The firm was founded and then IPO, 9 years. But how to improve the governance gradually in a firm, right? You hire a CEO who eventually takes the company public maybe 5 years before, put a proper financial and accounting system in place, hire the external auditor, really develop the governance system, recruit the first independent director to the board. Independent director is an outsider who does not have a conflict of interest with the firm. Get the CFO, who eventually takes the company public, get a legal counsel, right? And now, obviously, so what is happening is, as you are coming closer to IPO, you know your firm would be public. Lot many regulations will apply to you, which do not when you initially started, because you may not be a company actually, right? Initially when you start, and companies Act in India may not apply to you. But as you go forward, you become serious, right? The interesting question is, right, is it too late? Is it too early? Right? And that's an open debate, right? But what I always say is, and I have, whichever founders I have interacted with or entrepreneurs, they think, why do I need a board? That's the first question, right? It's not a statutory requirement. I've just started. It has been 1 year, maybe a few months. Why do I need a board? I said it need not be a kind of a board which you'd see in a company traditionally, right? Just have an advisory board, right? Because somehow we have a bias, humans, right? Whatever we are thinking is right. Okay, we are likely to be right because we have emotions attached to it. Obviously, you are going to wake up when VC investor questions, but do you want to wake up before that you go to a VC investor? So I always say, have an advisory board, right? I know mentoring happens, so mentoring is obviously different, but mentoring is slightly different from this, because mentoring can be personal also, as you are managing the high pressure job of running a startup. This is about advisory board, where a board will give you an unbiased view about how is your business performing. Are you going in the right direction, right? That is what. So they will question you, and obviously you can reap the networking benefits if you get outsiders on these kind of advisory boards. You learn a lot from their networks, right? And in fact, I mean, think about this as simple as that they might connect you to a VC investor, right? If you are finding it tough. So I always say, get your board ready, right? And there's one case I teach here, which is about one of the US firms, Pixability, where the owner herself got the board well in advance, even though there was no statutory requirement, right? So there's some stats here about the boards, right? On average, what happens to the board sizes and the board composition. First of all, let me make it simple by saying, so these are different rounds of funding. So please look at the left panel of my slide. So this is round number 1, round number 2, round number 3, round number 4. What it says is about, the board size. This is obviously coming from startups. Okay. On average, when you start initially, the board size is about 3 directors, right? And it increases to 3.5, goes to 4, and goes up to 5, right? So you start with about 2 or 3 and then goes up to 5. Still, it is much lower than on average a corporate board of the established firms, right? There it might go up to 7, 8. Right. But yes, firms do have boards quite early on, and I think VCs also like it because you can see VCs also like to be on the board. So this is the composition, right? Initially, a one VC investor is on the board, right? It increases on average. This is an average number. That's why it is in decimal. 1.29 goes to 1.67 and 2.35, right? And you can see that outsiders also increase 0.86, 1.12, 1.23, 1.6. So these are some of the controls which help you, right, in growing responsibly, right? And another way, these are the governance mechanisms which you would like to have in your firm. I think the final point or the last few points is about ethics, right? And people generally brush this aside, to be honest, right? But I've actually deliberately got 2 examples here from startups, right? So that today you do not brush it aside, right? And you can later on click on the link and see the news articles, relevant news articles. These are, Byju's is obviously popular, but Gensol, if anybody has not heard, this is about the Blue Smart electric cars they had launched in India. Just like Ola, Uber, they were largely, their positioning was on electric cars. And what Gensol did was that the Gensol owners, right, they got funding from VC investors, but they were using the money to buy this stuff, right? So I also teach a course on ethics here, and I ask my students about, will you do this, right? Any example I give, generally the answer is I'll do this if the law allows that, right? Ethics is not about that, right? Because when laws were set in place, the people, lawmakers, when the lawmakers set a law, they also thought about ethics. Then they decided the law, right? So you should not put a bar in front of you. If the law allows, I'm going to do it. Obviously, here the law did not allow. But what I want founders to think about, that do not, in the pursuit of profits and growth, you should not be taking a shortcut, right? And do not define ethics as law, that I will do it because the law allows it, right? The second example is very sad as well as interesting, that Byju's, there was one activist which has put a tweet on earlier Twitter, now X, that when initially Byju was growing, so this is about growing without control. This is a great example of this. So they were actually trying to onboard more and more students on the Byju's platform. So I think somewhere in Uttarakhand, the sales people of Byju's were promoting and trying to get the students for Byju's, more subscribers for Byju's. And they were, there was somebody, illiterate, and she really wanted her son to study well and get a good job later on. So she thought that, okay, my son is going to get a good education through Byju's, right? And she was asked to sign on a form, and she was told that, you will get this much of material from Byju's, your son will do good in school, there'll be a lot of material for practice. But she didn't realize that as she was signing on those forms, one of the forms was about so Byju said that I'm going to give you a laptop, but one of the forms was about that for laptops that she's taking a loan from a bank, right? She signed on that, but it was caught, right? That she was not aware that she's taking a loan. She thought, okay, Byju's is helping her, right? Now, obviously, because the consumer is naive here, subscriber, because that person does not have that much of knowledge. But you as a firm, should you be doing all this thing? So because there's so much of pressure on employees, there's a target you have given. Okay, I want these many customers by this month end. This way you're growing, right? But you are not growing responsibly, right? And Byju's response was equally sad. They said, we are going to look at this and we have warned our employee not to repeat this again. But Byju did not say that maybe inadvertently or indirectly they were encouraging this. They were quiet until finally the tweet came out. So I think this is my last slide. And so what my whole message was that work on profits, work on cash flows. Hopefully firms grow with profits and cash flows, but it can't be, without controls. The control mechanisms, which I talked about in the later part of my presentation, I would like you to focus on that, right? And with that, I think I'll stop. And if there are any questions, I'll be happy to answer. Hopefully, this helped at least some of you.
Thank you, Neerav, for an insightful session. Moving ahead, I would now like to request C. Anshu Jain, Managing Committee Member, to deliver a formal vote of thanks. And meanwhile, I request all the attendees to please type in your questions so that if there are any questions, we can take it before we call it a close. Over to you, Anshu.
Thank you, Ayush. Okay, that was quite insightful session. As it is rightly said, revenue is vanity, profit is sanity, cash is reality. Thanks to Professor Neerav for sharing such practical insights on unit economics and various other parameters like budgets, governance, incentives, which are crucial in each and every industry. I would like to take this opportunity to thank ICAI Singapore Chapter, BeyondSeed, Committee on MSME and Startup of ICAI, and CPA Australia for their partnership and sponsorship for the NEXTLEAP. Also, a warm thank you to all the mentors, founders, and our participants for joining us today and contributing your energy and curiosity to the discussion. The Next Leap 2025 continues to serve as a bridge between the startup ecosystem of India and Singapore, and we look forward to seeing you again in all our upcoming masterclasses. Thank you so much to everyone. Over to you, Ayush, for all the
Thank you,
questions now.
Anshu. I see there are a few questions. One question from Nikhil Chalani. What is the best source available in the market to be updated in startup ecosystem? I think BeyondSeed is the best to answer this in terms of the startup ecosystems. Millie, would you like to pitch in? I guess Millie is not there. We would type in the answer separately for this.
You can give some
There is,
suggestions, Ayush, if you don't
yeah,
mind, right? So at least in the Indian setting, I would say that if you are interested in getting a lot of financial information, that obviously Traction is one of the things, one of the databases which I really look at. Then IIT Madras, IIT Chennai has got their own incubation cell, and they are providing also a lot of data. And finally, Inc. 42, I've highlighted some articles from Inc. 42. That's really a good source.
thank you so much for covering that. I don't see any other question. Okay. So with this, as we conclude today's session, let's carry forward a powerful truth. Profitability isn't just a destination, it is a discipline. In the startup world where every rupee counts, every decision compounds. Mastering cost control and financial focus isn't optional, it is foundational. Build smart, spend wise, grow strong. The journey to enduring success starts with the disciplined choices you make today. Thank you for the wonderful evening. Before you leave, the next masterclass, number 5, which is on branding and marketing, is happening on 16th of October 2025, 4 p.m. India time, 6:30 p.m. Singapore time. The link will be shared with you in the community group shortly. Stay tuned.
Ayush,
Hi,
there is
Ayush. I
one
see
question.
two questions. Yes,
Okay,
I was just
let's
seeing that.
take them.
Maybe put that QR code of BeyondSeed on the screen again, so
Yes, I'll do
participants
that.
can scan that to be part of the investor community or
Sure,
the
sure.
startup community. So there's a question is how to participate as an angel investor. So that QR code would help to get in touch with
Right.
BeyondSeed.
Okay, let me do that.
For the recording, it would be uploaded on the YouTube channel. Allow me to share the YouTube link, the channel link. All the recordings of the masterclass would be uploaded over there. I'll just type it out in the message box.
So here is the QR code for those who want to scan the QR code and join the community to keep updated, be a venture investor. And if you are looking for a startup, this is the place to be.
Thank you so much, Ayush, for taking us through the entire session today. It was really great. And thank you, Kushal.
Thanks to
Yes.
you as well, Anshu, for the vote of thanks. With this, I
There
think
is one
Ayush, we
question:
can.
how could one participate in funding as an angel investing? That we have answered. What are the best sources? That we have answered. Okay, so these are done. So I guess all questions are answered. So yes, we have announced the next session as well. So with this, we would like to thank Professor Neerav Nagar for this session. Thank you so much for spending your valuable time with
My
us.
pleasure, Ayush.
Yeah.
Good to see you. And thank you very much.
Thank
Bye.
you so much for the informative session.
Thank you, Professor. It was
Bye.
amazing
Bye.
session to
Thank-
join. Bye.
Thank you. Thank you,
Bye.
participants. Bye.